you all very much for coming today. It is a pleasure for me to welcome Professor Schwartz today. The topic is a very broad topic, is the roles of central banks 10 years after the crisis, how much the roles of central banks have evolved, for the better or the worse. So we're going to have a discussion between Pedro and myself. Let me introduce you to Professor Schwartz for those of you who don't know him. He's been a visiting professor in Buckingham University for 4 years now, if I'm right. He comes in the summer to teach macroeconomics, international economics, and money banking and finance. He's been the president of the Montpellier Society, now the vice president, if I'm right, Pedro. He's been a professor of history of economic thought in various universities in Spain, international economics in general, and many other things. He's a fellow of the Institute of Economic Affairs, and many other things and distinctions that I'm not going to mention because we want to start at some point in this presentation. What I will do is to make an introduction to the topics we're going to discuss, then it will be for Pedro to do his, and then we'll engage in discussion. And of course we'll have time at the end, 15 or even 20 minutes if you wish to engage with the audience and take your questions, please. So again, as I said before, the topic is the roles of central banks 10 years after the crisis, how much they have evolved. And may I just say very briefly that the crisis did produce a major impact on our perception on the roles of central banks, a major change. Before the crisis, central banks were taken and even characterized by the media as interest rate setters, basically, like policy rate setters. It was as if central banks were not banks anymore. It was like a bureau out there in a sort of ivory tower, making decisions about changes in interest rates. All right, that changed dramatically during and after the crisis. Why? Because we realized in these very troubled times that central banks are first and foremost banks, banking institutions. They do provide financial services to a select clientele of banks. Which financial services? Credit regularly against collateral. In times of crisis, credit, extraordinary credit against collateral as well. Also, they provide clearing facilities for banks to settle their payments, which it is very efficient for banks to keep just a tiny fraction of their reserves at the central bank, for the central bank to oversee the settling of all the operations between the banks. So overall, the system becomes much more efficient by having a single central bank centralizing the reserves of the whole monetary system. That's another service provided by central banks. And in exchange, what central banks do is to supervise the accounts, the operations of the banks. It's as if you were, as I'm sure you are, a customer of a commercial bank and you ask for a mortgage, for example. I can tell you the bank will ask you for your wages, for your records, for your payment records. Why? Because the bank is interested in your credit history. The same happens at the macro level with the central bank, providing credit to the banking institutions, but also supervising the health of those institutions. So this is at the very heart of the central bank. From the very beginning, at the very beginning it was the banker of the government, and then it evolved into something much more like a modern central bank in the sense of the bank of the commercial banking sector. That's something very important we tended to forget before the crisis, and it has become very true afterwards. Another thing we forgot before the crisis is that central bank's remit used to be described as, well, the guardians of price stability, yes, but also financial stability. We quite forgot that second part of the remit of central banks before the crisis. So again, central banks were perceived as interest rate setters in order to achieve a certain inflation target, and did not pay so much attention to monetary stability and financial stability. And to some extent, ironically enough, they were very successful. They did achieve price stability in terms of the consumer price index inflation, But at the same time, as we know now, before 2007, they injected far too much money into the economy. Or to put it more precisely, they allowed for the banking sector to create too much money into the economy. And of course, that money did not evaporate. That money went somewhere. As you know, if you don't know, I can tell you now, one of the things that happened is that excessive liquidity ended up in an excess in the demand for other financial assets and real estate assets, creating what some people call a bubble in asset prices, both financial and real sectors. Yeah? So what I'm trying to tell you is that what the crisis has revealed is that we need to pay attention to both sides of the remit of central banks. Price stability, yes, but also monetary and financial stability. That's very, very important. And with this very brief introduction, perhaps, Pedro, you want to discuss some of the questions we're going to address later on, Yami.
Good.
Please.
Well, the first thing I want to say is that I'm very sorry that Professor Tim Compton is not here. I don't know if all of you know him. He's a passionate speaker. Trying to cross him is dangerous in excess. He's a great friend, and as we shall see, we agree a lot with him, but he really is quite a character. Because if he thinks that somebody is saying something wrong, then he goes at them. Absolutely. So I'm sorry, because that would have enlivened the meeting, no doubt. Now, I will start by saying that central banks have lost their way, obviously. They seem to be doing the great moderation, as it was called. They seem to be on the right path because the rate of inflation was low. They were beginning to have criteria for monetary policy in the sense of trying to get a rate of inflation, announce it and get it. This started in New Zealand, but went on, and even the Fed was thinking of it. And so they went well. And then not only that, but the economy was growing. And that meant that during the Great Moderation, which was from 1985 to 16, I think, to 16, well, it was a very long period of small ups and downs. And so we all fell asleep. And something happened which we didn't foresee. You remember the famous phrase of Her Majesty the Queen, why didn't anybody see it coming? And the economist who was telling her is a Spanish economist who now has gone into politics in Spain. And he was flabbergasted, didn't know what to say because nobody saw it coming, or very few. There are many people who say every year that there's going to be a crisis, therefore sometime they're right. So that the central banks have clearly lost their way. Now the second thing I would like to say is that central banks were supposed to be independent institutions from the government, sort of hovering above the market, doing the right thing with money, keeping the financial system going, but certainly not as government bankers as they used to be in the 18th century or 17th century. That was gone. But suddenly during the crisis, we saw on television the man from the Treasury, the President of the United States, and the President of the Central Bank, of the Fed, talking together and telling the people what should happen or what they should do. And that is a very deep change. So now we have to discuss how we can guarantee that the central banks will not be at the service of government. I don't mean that they shouldn't look at the stability of the economy and give it enough money and so on, but not finance the government, which in many countries that's what they do. They finance the government and then they have a runaway inflation. So that was the second thing I wanted to say. Then the third is, and we can discuss that, is that we know too little. We don't know what causes the cycle. There are many theories of the cycle, monetary theories, real theories, and so on, but none seems to fit the facts properly, and we don't know what happens. What we do know, since Milton Friedman and Anna J. Schwartz wrote their book on the monetary history of the United States, is that financial crisis and monetary crisis can make the things worse. So we don't know how it all starts. And in the case of the great crisis of 29 to 31, the economy was obviously on the real side going into a down cycle. But then the mistakes of the Federal Reserve that Milton Friedman showed, those mistakes made everything worse. And that's something that we've learned from Friedman. And in fact, Bernanke at some point had Friedman and Anna Schwartz in the room. He said, Milton, we learned. We're not going to repeat the same mistakes again. So the mistakes they've made are different ones. Bigger ones, I should say, but different ones. So we don't know much. Or we know very little, except that we should be very careful with money, because money is very matters, as Milton said again. So the answer when one doesn't know much is not to do much. Try to have some kind of criterion that will make the central bank become a fixed point around which people move, but not an active agency that tries to lead the economy this way or that. And that again is not only Milton Friedman, also Tim Congdon says that that since we know so little, what we should have is some rule to keep the growth of money steady and hope for the best, because we don't know enough to know what money does on the real economy. We don't know. And it's very important as economists to know what we don't know. That is, if you're a microeconomist, you know lots of things. If you're a macroeconomist, you don't. And therefore you have to be hugely prudent in what happens. So then there have been changes which we can discuss about the instruments that central banks use to control the quantity of money or even to influence the economy. And the big debate was, should we use the quantity of money? Should we use interest rates? Should we use the discount rate or the quantity of money? And the idea that it was the discount rate or the rate of inflation, the rate of interest, that was the instrument whereby central banks tried to moderate the economy, put it on the right path, and avoid trips up. That seems not to have worked, because we have rates of interest that are at zero, or even below zero, and it doesn't seem they've done much. What seems to have done to help us in this crisis was pouring money into the system rather than using the interest rates. So the question today is, if we have to make interest rate return to normal, and that's very important because industries like insurance and saving for your pensions and so on depend on the interest rate, and with these low interest rates you're really at a loss and losing money. So should we say, well, interest rates are not very important, get them back to normal and use the quantity of money to keep us on the straight and narrow? So we may have to change our instruments. We have to discuss whether the central bank should be independent of the government and what rules it should have, and then recognize that we know very little. And this is the introduction I want to make, but I think we can discuss a lot.
Thank you very much. Yes, indeed. So perhaps we can start, Pedro, with sort of an assessment on how central banks did during the crisis, with a very specific question, which is, did central banks act effectively as lenders of last resort during the crisis? And if not, what should they have done different or better?
Yeah, well, so the rules for central banks when they face a crisis of their banks, and indeed it is true, as Juan said, that a monetary system or a financial system is a club of banks headed by the central bank. And the central bank is there to save them if things go very badly, and also to keep an eye on them, inspect them and tell them what they shouldn't do or what they shouldn't do. So the central bank is the head of a club, and what they did one of the things they have to do is be the lender of last resort, as Bagehot said in 1873, not 1973, we go back a long way. Money doesn't change. You have the same problems cropping up time again, because it's so abstract that it works in any society. Anyhow, the lender of last resort, with Bagehot was under a certain rule. You have to save a bank that had a solid balance sheet and lend them money at punitive rates. But that seems to have gone out of the window with this crisis, because in the end, either they let them sink, as happened with Northern Rock and happened with Lehman Brothers, or they saved them by nationalising them in a huge way. And then the other instrument is guaranteeing your deposits. That is, the government says that you won't lose £75,000 if your bank sinks. And that guarantee of deposits, again, is something we could discuss, because many people criticise it. So the banks haven't done well before. They had too low interest rates, I think, as Taylor of the Taylor Rule says, that those interest rates were too low under Bernanke, and that created a bubble. When you reduce interest rates, the prices of assets go up. The prices of bonds goes up, stock exchange, and housing. And so if you try to use the interest rate to save the country from a slump, then you have this negative amount, and if you put it too low, then you have other industries going badly. So my question is, should we forget about interest rates and think again about quantity of money?
Oh, that's very interesting. But may I go back to your points about the lender of last resort?
Yeah.
Perhaps one thing central banks didn't do very well during the crisis is to pick and choose which institutions they wanted to lend out money readily, even at a punitive rate, but readily and timely, and which ones they didn't. So maybe we should have a much more robust and systematic way to face this problem. So, for example, something that is very straightforward to me is just to follow the rules or the criteria established by Walter Bagehot in 1873. One is, okay, you have a central bank knocking at your door, asking for extra liquidity, but they can present good collateral to back that loan. That's enough. In my opinion, that's enough to lend out money timely, readily, against collateral. That's absolutely enough. What you should not expect central banks to do is to pick and choose again which bank is going to be rescued by the Treasury, for example.
Well, that is the point. It's very difficult, if you look at balance sheets of banks,
Yeah.
to know which one is safe and which is not. Because banks can do all sorts of things to their balance sheets.
Yeah, but
So the attitude of the central banks later
Yeah.
was not to say this or that, but to pour money into the system by making it more liquid for everyone.
well,
And so that's an answer to,
yeah.
I won't pick this bank or that. I will simply
Yeah.
give liquidity to a country, to a system that feels that it's in danger.
But I'm sure, Pedro, that you and me, we both agree central banks shouldn't do that. Shouldn't pick and choose which bank survives and which bank shouldn't. It should be much more based on the technical criteria, on the collateral presented to the bank to make a lending. Do you think?
Well, in the case of Northern Rock, people criticised the way they were financing themselves. They gave very long-term mortgages, and they got the finance from the money market, which is short-term, overnight sometimes. So they say this is unsafe, because if you have a problem, then how do you sell your mortgages to be able to cover your finance? But the truth is, the Bank of England said they didn't want to touch Northern Rock, which has been criticised here a lot by Jeffrey, for example, before the and Tim. In the parliament. They didn't want to touch Northern Rock. It was nationalised. Then it's been sold at a profit. So was it or was it not solid? It's very difficult to know whether a bank is solid, and perhaps the best way is to put money into the system rather than in this or that bank.
Okay. So moving on to something a little bit different, but connected to your first statement. Have central banks lost their independence? I think that you already answered to this question during the crisis. How would you regulate or define the relationship between the central bank and the government?
May I say that it's perhaps government who's lost their independence and they're all in the hands of central banks.
All right.
Especially in Europe. So, yeah, but the three are in cahoots, and that obviously is very dangerous. What rules could we have for that? That is very difficult again. The world of banking is murky. I don't know how many of you have seen banks or studied those balance sheets. It's very difficult to tell because they lend long term and they get their funds short term, and so we don't know whether they are safe or not. So that's one thing then. So how can we keep the central bank independent? I think by having a rule for the central bank, rules that tell you how they have to conduct their monetary policy, and that makes them independent. Of course, if there's a crisis, perhaps they have to come in and help. But in general, the idea that banks can short-term pick a policy and do this before the elections and that after the elections, all that, if we could have rules for central banks, then they might make them independent.
Yeah, because something perhaps we should have clarified before is that at the lender of last resort, we don't mean the central bank bailing out a specific bank. That's not the role of a central bank. It never was. That's for the other market competitors to buy that bank in trouble, or for the government to nationalize the bank. But by the lender of last resort, we just mean now, is providing extra liquidity to
the whole system.
Yeah, or to a specific bank in trouble against collateral.
Mm-hmm.
That's how it should work. But because again, it's not for the central bank to nationalize a commercial bank. That's the decision for the Treasury. It's not the central bank the one in charge of it. Yeah. So going back to independence, Pedro. Because we have discussed this before, I'm very much in favor of privatizing the central bank. So a privatized central bank with an interest in the proper and sound running of monetary affairs would know, in my opinion, when, if at all, to intervene in the market and lend out money to a...
I hope you're all shocked. I mean, here are two people who are teaching about central banks and you want them to privatize them. They used to be private.
They used to be privatized before the Second World War, weren't they?
Yeah.
In most cases, yeah.
But
and it didn't go that bad.
Tim Congdon is in favour.
He's in favour.
I'm in favour. You're in favour. In fact, your thesis was on that.
And yourself.
so we are not being neutral there.
Yeah.
But yes, if you see a central bank as a business that gets its profit from the size of the market where its money runs, that is, from seigniorage, the difference between creating the money and what it can buy. And so central banks should think about how to increase the number of people who use their currency because it's safe and because people find it useful. And therefore, in that case, if a central bank has that as a motive, a profit motive, the increase in the zone where its currency is being used, and that's how they get their profit, then that might be one way of making them private.
That's precisely my point, because in good times it would be for the central bank, again, a privatized central bank, to set up, to abide by a rule in order to maintain the purchasing power of its own money. And that money, that standard, is going to be used by the rest of the banking sector to issue their own money, their own bank money. They are all going to share the profits coming out of running a stable and strong currency. Remember, this metaphor that you used before, which is Schwartz, if I remember, the central bank being at the head of a club of banks, commercial banks, issuing means of payments in the money, in the currency issued by the central bank, is perfect. So, does the head of this club have an interest, a profit interest, in running properly this business? Yes, indeed. Both in the good times and also in the bad times. the central bank wouldn't be told, in that scenario of the privatized central bank, wouldn't be told by the government to bail out or to lend out money to one bank or another. It would be in the interest of the central bank to decide if this bank is going to be given the money it's requesting or not.
We should later say something about deposit guarantee, which is the other thing they do. But before that, all right, you have the head of a club that issues its own currency according to rules decided by perhaps by the legislature, saying you ought to keep the rate of interest steady, or the rate of inflation steady, and so whatever the rules are. And then they are really a monopolist in the country. They issue this money and they have a monopoly power. And that is something that when I hear, among others, Tim Congdon, and I'm sorry that he's not here, when I hear that the bank should be ruled according to, or made to abide by a rule, and that rule, and that bank should be the monopolist of issue of legal money, then in the world we're not like that. We have an oligopoly of currencies. If a central bank really goes bad, we can always move into the dollar or the yen or the Swiss franc, whatever, as long as there are free movements of capital. So it's not, they are not monopolists, they are oligopolists. And if the oligopoly is more or less well run, it goes well. It's a bit like the oil oligopoly. You have a big country there, which is Saudi Arabia. They increase the price of oil up to a point. They don't want to kill the goose that lays the golden eggs. So not only privatizing, but also having free movement of capital so that people can move to a safe haven if the private bank that they use is... well, in fact, with money you have not only money for exchange, also for future value, and therefore you could have in some places, as you had in Argentina, the pesos being used for every day for paying the bus and the milk, and dollars used to value and to pay for housing. And I heard the same with in Zimbabwe. They went on using the Zimbabwe shilling for small expenses, but they all thought, and even exchanged, either rands or US dollars. So we've designed a bit how it could be that the central banking system should be private. It's an audacious proposal, and I'm glad that Tim is not here because he wouldn't perhaps agree on all of it. But still, here we are. It's a possibility. In a university, we can think silly thoughts without endangering everyone.
It's quite a lot we're putting here to the audience, isn't it? So remember, we're saying that central bank should be abiding by a sensible rule by which it maintains the purchasing power of its own currency. It should be independent from the government, ideally a private institution, not something else. And your third point, the currency market should be a disputable market, should be open to competition. So that's
because we can use the pound here, but perhaps for our pension, we have a pension fund that has yen and has Swiss francs and so on. Mm-hmm. So there, the manager of the pension fund will be hedging the risks by using more than one currency. You mustn't think that when the currency is that of a country, it's monopolistic in the fact that everybody uses only that. That is not so. We use many currencies, not only in notes, but also in our investments. We invest all over the world. So we all of us are using many currencies to cover ourselves.
And that's precisely the reason why I think that a privatized central bank will have the incentive to maintain or to expand these synergy gains by maintaining the purchasing power of its currency, because it would be competing with the other clubs, with the other currencies. Mm-hmm. So perhaps if we can move on to the third point we want to discuss before opening the dialogue with the audience, is that, Pedro, now 10 years after the crisis, everybody's talking about returning to normal, the so-called normalization of monetary policy, which effectively means shrinking the balance sheets of the central banks And why not saying it's increasing interest rates? That's what they mean. So do you think that this is sensible? If so, how should they do it?
My view from what you heard before is that the instrument shouldn't be the interest rate.
Mm-hmm.
Keeping the interest rates at zero doesn't seem to have done much. And in fact, as I say, some industries are in trouble because of that, especially the life assurance industry. They have periods of 60 years for assets, and they're clamoring to be able to invest in something, and that investment doesn't give them a return. So, in fact, in life insurance, if we looked at it, perhaps it's not as sound as it looks because of that. So it shouldn't be the interest rate. The question is, should we reduce the amount of money that, the quantity of money that has been put into the system with quantitative easing and so on? Isn't the world economy awash with money? Aren't companies full of money? And therefore, would it be not too dangerous to reduce the amount of money? Or, as Tim Congan says, we want to keep M4 growing at the steady rate, the same rate as the long-term growth of the economy. And if we try to reduce the amount of money in the system, perhaps we will stop growth. So I don't know the answer, but certainly I would leave aside again interest rates. They forgot about them at the Bundesbank and other places and the ECB because they said it took too long to have an effect. But yeah, we're doing something long term. We're not trying to arrange the economy next quarter.
In my opinion, what is really depressing in all these debates is that money or the analysis of monetary changes in the economy virtually plays no role in all these discussions nowadays in mainstream media and economics. So that's why I do really support paying attention to money growth. Yes, it is important to diminish the balance sheets of central banks, but let's do it sensibly if we want to do it. By sensibly, I mean pay attention to the rate of growth of money, broad money, in the economy. What we don't want to do is to provoke another recession by shrinking too much the size of the balance sheets of the central banks and cutting down spending again.
There's another industry that suffers from low interest rates, and that's banking.
Oh, yeah.
They cannot. They try to pay as little as possible for our deposits, but then they lend them out, but the return is so low. And so what they may do is take more risks than they should, because they have small return. And in any case, the banking sector as such is shrinking. Commercial banks are becoming smaller. I don't know whether we can afford that, but that's what's happening. So the banking system is another one that suffers from these zero rates of interest that we should forget. So what I would say is, careful about the quantity of money, but try to forget about interest rates and put them up. I don't think they haven't done much when you lowered them. I don't think they'll do much when you raise them.
Yeah, one thing is interest rates. What they call normalization of interest rates, putting them higher, and that's what you say here. Mm-hmm. The other thing is reversing the amount of that amount of money injected in the.
Well, the thing is that that amount of money hasn't really caused inflation.
No, it hasn't.
Because people have kept it. Now, it may be that all the money that's washing around, in the end, will go into prices, and in that case, they will have to reduce it, the quantity of money, to try and avoid inflation. But at the moment, inflation is not a problem.
Yeah, no.
So you may be easy on that.
No, we agree. But what I'm trying to say is that we should put this question into the context of a proper monetary analysis of the economies. So the answer to the question should be: is that amount of money we have created in the last 10 years inflationary? Will it be inflationary? If so, yes, withdraw that money from circulation. But that's the debate we are not having. That's the debate that I don't listen to, I don't hear by anyone out there. We here at the Institute of International Monetary Research seem to be the only ones putting monetary analysis on the table. And that's what I'm really lacking in policy debates, really.